Well, this will be the final part on financing. I would like to use examples to provide some illustrations of how important financing is, and how perhaps to carry out some very high level initial evaluations of how the financing on your investment could turn out. As part of the purchase process, there are different steps that are taken with regards to money. The first is normally what I'll call equity. And this equity, by this I refer to the money you have as an investor. This money has come from savings or has come from other sources, such as investing. So as you're purchasing a property, it could be that the equity you've created has either come from your savings or some investment opportunity, or that you're raising credit, and this could be coming from a mortgage, or this could be coming from a loan or from a creditor. These funds are then allocated to the purchase of a property. But this is the first stage, because in order to buy this, you are going to have to finance the purchase. You will be allocating capital for the purchase. Whether that capital is your capital or a combination of your capital and other people's money. In securing this purchase, we come into financing. And once this purchase has been secured, we go into the stage of management. Now, financing is important because at every single stage, it plays a part. If you're buying your property to let, then you will be involved in all of these stages. You would secure the property, you would purchase the property, then you would manage the property. If you're buying to sell, then you would be involved in only two stages. You would buy, secure, and sell. Nonetheless, you will have to deal with financing, and in the prior two sessions, I made some attempts to explain some of the ways you could consider how you could finance your purchase. Let me use an example. A friend of mine, approximately, I think, 4 weeks ago or less, spoke to me, and he said, I'm buying a property. We just walked out of a house we just viewed, or property we just viewed, and we like it, and we've made an offer, and we are waiting for the offer to be accepted. I asked him some questions. He said the property was about 800,000. And he said, well, we hope the offer is accepted because I am selling one of my other properties. And we are allocating all the capital or equity we have for the purchase. And he said, I am buying this property with equity. In other words, he's paying for the property with his own funds. To which I patiently waited for him to, explain how the purchase was going and what the house looked like. And towards the end of the conversation, I asked him a question. The question is the question that I will be putting across to you. I said to him, I said, why would you be using equity when the cost of debt is the lowest it's been in 100 years? And he said to me, because I want peace of mind, or I just want to, I just think it's the right thing to do. 2 weeks later on, he called me back and he said, well, the purchase process is going through, but he said to me, I have a question. What do you think I should do? And I said to him, well, right now, the cost of equity is about 7%. In other words, your cost of financing the transaction is about 7%. Now, this is where we get quite descriptive. Let's assume that the property purchase, the total cost, not just the price or the cost of buying the property, let's say including the transaction cost, but let's assume it's 800,000 and the cost of equity is 7%. This would mean that he would have £56,000 to pay every single year. This is annual. This would be in interest. So if that equity had come from equity investors and they said, we'll give you this 800,000 to buy the property, but we want 7%, then the annual cost to meet the interest of the equity investors would be 56,000. I said to him, well, currently it's possible for you to get a mortgage for about 3.56%. But if you have good credit and if you have a strong deposit, you can get it for much less. But let me use 3.5% as a benchmark. On the other hand, if he had secured funding, in other words, this is cost of equity, if the cost of capital, which would be a combination of equity plus debt, he could secure it for 3.5%, his cost would be 28,000 annually. This would be, in other words, what he would pay for his mortgage. The difference between using equity for his purchase or using some debt is 28,000 annually. If he purchased the property and he was going to hold the property for 30 years, you could say that the saving over the entire period, assuming that the cost of equity stayed at 7% and the cost of capital stayed at 3.5%, would be this, which is 840,000 over the duration of ownership. Now, why is this relevant? Well, by understanding how to finance your purchase, he would save 840,000, which is greater than the cost of the property itself over the entire period that he owns the property. Now, a different way to look at this number would be to say, if the difference between 56,000 and 28,000 is 28,000, then you could use this equation to find out what the value of the saving is over the entire duration. This is what we'll call a perpetuity equation. So we would say your 728,000, in this case, this is the discount rate, or 3.5%. G is the risk-free rate, which currently is 0.1%. So this will be 3.5% minus 0.1%. This is 823.5 thousand. So on one side, if you use the perpetuity equation, it's 823,000. But if you used the actual duration calculation based on 30 years, it's 840,000. This simply means that by deciding to finance intelligently with debt, he would be saving more than the cost of the purchase over the entire duration of ownership of the house. That's one example. I'll give you a different example. This goes back to roughly 6 months ago. In a conversation with someone, they mentioned that they were about to purchase their first property, and this is a couple. I'm going to use 500,000 as the cost, although I did not ask what the cost of the flat was. I believe it was something in the region of about 400 plus. But I'm going to use this to explain or to show how the financing would have looked under different circumstances. Now, let me start by saying this was roughly around February. And in the conversation, he said, well, we've found a place, we've secured a mortgage. We've also secured a mortgage, and we've used a 5-year fixed rate. And we're happy. At this point in time, the Bank of England borrowing rate was 0.75%. I could be wrong. I really could be wrong, but I believe it was 0.5%. But please, if I'm wrong, my apologies. I do not have access to verify or to validate the accuracy of my statement, so please forgive me if I'm wrong. What this meant is, at the time, most banks were charging what would be the bank rate plus the Bank of England borrowing rate. At the time, this, if I recall, this was roughly 3.5%. So he would be paying, or they would be paying rather, since both of them are couples, they would be paying roughly 4.25%. For simplicity, this is the purchase cost of the house. However, he would be providing a deposit, and then there will be a loan. If we assume that his deposit was 100,000 and the loan was 400,000, this would then be used to calculate the cost of capital, assuming 7% and assuming 4.25%. The cost of capital would then be the weight in equity times the cost of equity plus the weight in debt times the cost of debt. This would simply be 20% of 7 plus 80% of 4.25. So mistake. His cost of capital is 4.8% as a result of the arrangement between debt and equity. Let's bring this into what I'm trying to get at. If we were to just freeze the 500,000, and we'll use this as an example. If we say that if he was paying using 4.8% for a 5-year period, then annually, on an annual basis, he would pay 24,000 annually. This 24,000 will be equivalent to £2,000 per month as a mortgage. Now, please understand that I'm using 4.8, which is the actual cost of capital, rather than the 4.25, which is the cost of debt. But because he has put down a deposit, you have to calculate the weighted average between the cost of capital, the cost of equity using 20% equity, plus the cost of debt using 80% debt. And that is the reason why we have 4.8. I've then made the assumption that we'll keep this fixed, this 500. But I know, and you know, that every month, depending on the mortgage he has, as he pays 2,000 a month, the total debt he owes the bank reduces. I'm not going into the distribution between principal and interest because that would make this more complicated. So I'm keeping this fixed. And I'm only using this as an example just to show how to think about financing. So £24,000 annually would be his cost. Over a 5-year period, this would amount to 120,000. This would be what he would pay, or what it would have cost him as interest payments if this was kept fixed. During the conversation, I made a number of statements, and I share this just so you understand how to think about such matters. Darwin is known to have said that whenever he found an idea that contradicted a previously cherished belief, he made it a duty to write down the idea very quickly, because the human mind was designed in such a way that it would reject the belief. Firstly, my response to him at the time was, is this the right time to be buying? Whenever you make investment decisions, there are two aspects of an investment process that will affect the investment. One is micro, and the other is macro. Micro deals with the fundamentals of the assets. Macro deals with all of the conditions that influence the political, economic, social landscape. So this would involve interest rates, currencies, inflation, including any other geopolitical issues. In investing, it's important to focus, or to keep your focus on what's important and knowable. The micro is important and knowable because you can identify what the value of the property would be, looking at the cash flow, looking at the risk, looking at the growth. The macro is important, but it's not knowable in advance. So to predict interest rates and inflation and currencies in advance consistently is very difficult. So usually we tend to focus on the micro, but we try to understand what is going on the macro. This conversation we had occurred around, I believe, the end of February, sometime towards the end of February, the last week, I believe the 26th or the 27th. And at that time, it was quite easy to understand what the macro environment looked like. The coronavirus had started. I made a number of comments to him. The first was, I said, I think you should delay the purchase for a number of reasons. I said, firstly, you should not be going for a fixed mortgage. Number two, I said the Bank of England rates will fall in the next month or two. And number three, I said the cost of the property, because of the shock coming from the uncertainty based on the coronavirus, would cause a slight displacement, and it will not be unusual to see that the 500,000 property might go down by 5 to 10%. I said if it goes down by 10%, you could buy the same property for 450,000. But the beauty is something called the law of three, which is if the property went down by 450 and the Bank of England rate reduced and you were able to secure a variable rate, then you might have a much more attractive opportunity. His response was, well, we've made up our mind. The bank's mortgage advisor says fixed is better than variable. They also informed us to fix it and that to go with the current Bank of England rate. And we do not want to do a detailed valuation on the property. So in other words, they were making this investment purchase out of ignorance and refusing to consider any words of reason. 6 months later, which is where we are today, the Bank of England rate has gone down to 0.1%, which simply means if you were to take this 6 months later, as a matter of fact, a week after that conversation, the Bank of England reduced the rates from 0.75 to 0.5. I saw this same person and I said, have you changed your mind? And they said no. Within another 2 weeks, this is roughly around the third week of March, the Bank of England reduced its rates to 0.1%. Now, all of these changes took place in the space of 3 weeks. At that time, his purchase had not gone through, so he had the opportunity to change the arrangement he had or they had with the bank, but also they had the opportunity to renegotiate on the purchase price. I believe most people are always in a hurry, that they refuse to stop and just think. The Bank of England rate from the month of March has stayed at 0.1%, the lowest it's ever been. I believe quite similar to what it was during the financial crisis in 2008, but the lowest it's ever been in history. Had he waited, this is what would have happened. The cost of debt would have been, if we use the same amount, currently banks have also reduced their rates from 3.5 to 3.4%. And this is across most banks. He would have been paying 3.5% as the cost of debt. In addition to this, if we were to use the same numbers, this would mean that using 20% equity plus 80% debt, his cost of capital would have been, or would be, 4.2%. That difference is significant. That's roughly a 12.5% reduction. Let's put this into context. So, using the same 500,000, if he was paying 4.2%, then he would be paying 21,000 annually, as opposed to 24,000 annually. Over a 5-year period, he would pay 105,000 as opposed to 120,000. So the saving over the 5-year period is 15,000. Now you might think, what's the big deal? Well, if you were to come back to this, he's paying £2,000 per month. If he had waited, he would be paying £1,075 per month. This would be equivalent to saying that if he saved 15,000 during the whole duration, it would be equivalent to having roughly 9 months of his mortgage saved. And that is a lot of money. The second part of the lessons learned was the reason I suggested that he reject the fixed rate was simply because by fixing the rate, as the Bank of England rate started to go down, he was discounted from participating in the reduction. I made a statement earlier on, you must understand market cycles. Whenever the interest rates are likely to go up, you want a fixed rate so that you fix the cost of capital. Whenever the interest rates are likely to be going down, you want a variable rate because as the cost goes down, you save. Now in February, it was very easy to know or to see that the Bank of England rates was going to go down. By March, second week, the Bank of England had made a statement, the Federal Reserve Bank had made a statement, the ECB had made a statement, and their statements were that they believed that the rates of borrowing would remain at the lowest, or rather would remain at this level. And the Fed was very explicit. It said that it would remain at this level for at least 2 years. So my recommendation to this gentleman was, you can choose a variable rate for 2 years. And then at the end of the 2-year period, you can reassess the state of the economy, and then you could either choose another variable rate or you can fix it. We are going through uncharted territories in relation to financing and in relation to economics. In many parts of the world today, we have negative interest rates. As of today, the Bank of England is considering reducing its interest rates from 0.1% to something that would be negative. Now let me put this in context so you understand. If your bank is offering you 3.4% and it has to pay, or the bank has to pay the Bank of England 0.75%, then just like the original calculation we did, this one, you would be paying this. At 0.1%, you are paying this. if it goes negative, say it goes to negative 0.25, it would mean that the bank, let me make sure I get this right, it would mean that the bank will be paying part of your mortgage for you. Now, I use this as an explanation just to show that it's important to understand how to finance your transaction. If we were to purely just look at the saving between what he selected or what they had selected in February and today, what I'm suggesting here is the cost of debt to him has gone from 3.5, or rather would have gone from 4.25 down to 3.5%. Which is a saving of roughly 1.4875%. 1.4785% every year is 7.4 thousand. Over 5 years is 37.74 thousand. That's what he would have saved. I hope this has been useful. My intention is simply to say it's important to think and to allow people who perhaps have an understanding above where you might be to provide potential ideas that are worth considering. I have only looked at this from the aspect of changing from fixed and being patient. But let's say, for example, he had waited and the property had fallen in price by 5%, then he would have saved 25,000 if the property had gone down by 5%, because the property markets were rattled. So 25,000 plus 37.75 thousand. It's roughly 62,000 he would have saved over the 5-year period. And that would have come